Hi guys, welcome back to our channel, The Joyful Investors. We have been receiving some comments from people asking about what to look out for when starting to invest. So today, I'm going to share with you the 7 common mistakes that new investors tend to make. And before we start, this is going to be a long video, but do stay with us as I assure you that what I'm going to share with you are definitely the top mistakes that new investors make. So let's get started. Mistake 1. Failure to set realistic investment goals and expectations. Many new investors fail to set realistic investment expectations when they first started out investing. So they expect to see very high returns within a short time frame, or they have totally zero risk tolerance. Once they buy a stock, they expect that the stock market should only move in the upwards direction. And so if they see that the stocks are not making money as what they had expected, they start to panic and they sell off all their positions. Often, this results in making losses. I'm not saying that it is impossible to make good gains within a short time frame. But when it comes to investing, there is certainly nothing speculative in nature. While it is a bonus that we make good gains within a short time frame, this is something that is less of a concern for us as investors, because in investing, we are more concerned over the longer term outlook. So what has gone wrong? New investors often forget that the stock market can be volatile. We always say that in the short term, the stock market is a voting machine, and in the long term, a weighing machine. Prices do not always accurately reflect a stock's worth because of the changing sentiments of the investors. But if you were to buy the stocks of a fundamentally strong company, then you would generally expect that the stock prices should move up over time. Just be mindful that stock prices do not go up every single day. Therefore, as an investor, we need to set realistic investment expectations for our investments. Know how long you want to hold investment for and what kind of returns you're expecting. Also know what is your risk profile and risk tolerance. How much paper losses are you able to tolerate? If you are unable to tolerate high fluctuation in prices, then perhaps you can start off with investing in ETFs, because ETFs are generally less volatile as compared to the individual stocks. At the end of the day, make sure you have given due consideration for your investment goals and expectations, as well as your risk appetite and your risk profile, because you do not want to have unnecessary losses that happen because of panic selling when the stock market is not moving in the direction that you expected it to move. Mistake 2. Making your investment decisions based solely on the emotions. This is really one of the top mistakes that new investors make. So they base their buying and selling decisions of stocks just based solely on their emotions. So for example, when it comes to buying of stocks, they buy out of greed when they see that the stock prices are increasing, or they get FOMO and they buy the stocks when they see that their friends are also buying. So a lot of times they end up chasing after the prices and end up buying the stocks at an overly high price. To make it worse, they also do panic selling. So when they see that the stock prices are falling, they are scared that they may lose even more, so they end up selling off their positions. So they end up in this situation in which they're buying at a high price and selling it at a low price, and therefore making these losses. And in fact, many retail investors, not just new investors, are still guilty of making such a mistake. And these emotions are usually manipulated or influenced by the news and the media. So I want to share with you this very important tip. Do not ever let your emotions overpower you and make rash and irrational decisions that you will regret later on. What you should do is to do your homework and perform thorough research to find what are the fundamentally good stocks to buy. So even if it is unfortunate that you enter the stock market at a point just right before the stock prices drop, you should not be scared of if you are already holding on to the stocks of fundamentally strong companies. Take for example the SPY ETF. If you had entered a position of SPY at US $140 just right before the prices declined by 50% in the 2008 recession, you would have profited by 140% by now, giving approximately 10% annualized return. Let's take a look at a more recent example. If you already hold a position of SPY before the start of 2020 and was disciplined enough not to fall to the traps of panic selling, you would still be up by more than 10% return for 2020. Now you can do the comparison for yourself. What would it be like if you had instead sold off the position when the prices fell drastically during 2020? So you see, if you are disciplined enough not to let your emotions overpower you, then you are likely to do much better than many of the retail investors out there who are driven by emotions. This brings me to the next mistake of investing just based on news or analyst opinions. So we often hear people say that do your research before you start investing. But what they did not say is what kind of research should we be doing? Reading up news media articles and being led blindly by these news media articles is not what we consider as doing a proper research. Performing proper research involves understanding the business of the company, the financial performance of the company, as well as many other factors such as the sustainability of its business model. So for example, if you're analyzing on REITs, then you will do better by reading up on the statistics for the trend of occupancy rates or the statistics for the trend of the price per square feet, rather than just relying solely on the opinions on investing forums. But am I saying that you should not read the news or the opinions of the other investors or analysts? Do not get me wrong. It is good that you are reading up the news because you have to keep yourself updated with the current affairs of the company. And it's also always good to read up about the opinions of the other investors or analysts so that you know how they think, what they think, and how they act. What you should not do is to read up on this news and opinions and be led blindly by what you read and to form an impression on your buying and selling decisions just based solely on what you read instead of based on hard facts or statistics. So let me give you this example. Have you heard of this company called Fastly? Fastly is a content delivery network company that transmits data to the end users. So sometime back in October 2020, the share price of Fastly had dropped by about 50%. So at that point in time, if you're reading articles, you would have probably seen two sets of differing views. So one being that we should buy Fastly stock right now because the stock prices have already fallen drastically. And the other being that we should still not buy the stocks of Fastly because they're just simply overvalued. So if you happen to have read articles that stands for the proposition of buying Fastly stocks right now, then you would probably have already been convinced by it. But if we now take a closer look at the financial performance of Fastly, we realize that Fastly has a history of negative operating cash flows, with 2020 being the first year that it turned positive. And Fastly also has a history of negative free cash flows and negative bottom line and so on. I'm not saying that Fastly is a bad company to buy. It may be a good buy in the future, but right now I'm not comfortable with adding it into my portfolio because I had applied a certain set of criteria to screen for fundamentally strong companies to buy. Until I see consistently good or improving performance, I will stay out of this stock for now. So in that case, why do we still have to read the news media articles or the opinions of the other investors? Well, that's because it allows us to have an understanding of the general market sentiments, which is the one that is driving the price movements. So for example, if let's say there is some negative news for a particular company that you deemed as a fundamentally strong company, and you know that this negative news is just temporary and will not affect the future performance of the company. So you are likely to want to take on more positions or enter more long positions of this stock when the other retail investors go crazy with the panic selling, pushing the prices lower. The next mistake is the lack of diversification in your portfolio. So some new investors, they are inclined to just throw all the money into one single stock that they hear from their friend, hoping that this one stock will be able to earn them some good returns. As a general guide, it will be good for a new investor to start off with around 4 or 5 stocks depending on the size of your portfolio or the size of your capital. So by diversification, you can do so by diversifying by the industry. So say for example, you buy from the tech industry or the healthcare industry. Or you can also do diversification geographically by buying stocks from the US market or the Singapore market or even the China market. Diversification, however, is not just throwing your money into any stocks that you see. We've got to ensure that we still screen for the fundamentally strong companies to buy. So because if let's say you are buying both good and bad stocks and adding them into your portfolio, then you may end up in a status quo or even worse off position because the losses from the bad stocks may offset or even exceed the profits from the good stocks. If you find that taking the time to find a basket of stocks to buy seems to be too tedious for you, then perhaps you can first start off with investing in ETFs such as the SPY ETF. Because by investing in an ETF, you are actually as good as investing in the basket of companies that the ETF tracks. But do take note that when you're investing in ETF, you should ensure that you find out what are the companies that the ETFs track, because you do not want to end up in a situation in which you are over allocating your portfolio to certain industry or certain particular companies, because it is possible that different ETFs track the same companies. The fifth mistake is blindly buying at the bottom. We always say buy low, sell high. This is like the number one catchphrase for all investors. But we need to understand that not all stocks will rally up in the long term. So for fundamentally strong companies, generally the stock prices will rally up over the long term. Whereas for weaker companies, they may take much longer to recover or never even recover at all. So new investors may fall trap to the attractively low prices and add some positions to their portfolio, not knowing that there is a high chance that the stock prices of the stocks will not rise. So I'm going to show you some local examples which may catch you off guard. When you see this stock price chart, what is your first impression? You will probably be thinking that this must be some Singapore company that you have never heard about. And actually, this is the stock price chart of Singtel, the top telco company in Singapore. Singtel stocks have been on a downtrend since 2015. So if you have started out investing back in 2015, you may probably be enticed by the declining prices, thinking that you can enter some positions at a low price, so that you can close off these positions in the future at a higher price. Because that's what we always think, right? To buy low and sell high. Coupled with the ingrained impression that Singtel must be a very safe stock to buy because it is the top telco company in Singapore, backed by Temasek Holdings, which is substantial shareholding in Singtel. But after holding the stocks for 5 years, you will find yourself in disappointment that the stock price dropped by about 50%. Recently, it was announced that Singtel was awarded a license to operate as a digital bank together with Grab. As a result of this announcement, Singtel saw an upward trend for the first time since the last 5 years. But if you ask me, I think there is still insufficient information or statistics about how the digital bank license will help Singtel to turn around in order for me to be enticed to buy Singtel stocks as of now. Let's take a look at another example. Again, this example might surprise you because this is the stock chart of Singapore Post. Singapore stock prices fell by more than 15% since 2015. Yet, we still hear people around us talking about investing in Singapore shares despite the clear downtrend. I'm showing you all these examples to tell you that it doesn't always mean that when stock prices drop, you must definitely buy. In fact, we should also look at the financial performance of the companies and many other factors to determine if the stock is a good buy. So let's take a look at the financial performance of Singtel and Singpost. So both of these companies do not have consistently increasing revenue or increasing gross profit or net profit. And this is just some of the many indicators that we look out for. Clearly, it makes more sense to put our money to other stocks that are a better buy. While past performance is not a guarantee for future performance, I am someone who rather place my bet on a horse that has proven its worth over time but is unloved now rather than just placing my bet on a horse that requires some miracle. The next mistake is the failure to realize that the stock market is forward-looking. So many investors do not understand that the stock market is not the same as the economy. And in fact, the stock market is forward-looking and always leads the economy. So why is this so? According to Investopedia, the stock market refers to the collection of markets and exchanges where regular activities of buying, selling, and issuance of shares of publicly held companies take place. Now ask yourselves, Who are the ones involved in the buying and selling of shares? Yes, that's right, it's the investors. As we have shared in our earlier points, investors are driven by emotions and sentiments. And these sentiments include what they think about the future performance of the company. So if let's say the investors are optimistic about the future performance of the company, then they are likely to be willing to buy these stocks at a high price, therefore driving the prices up. Therefore, the stock market always leads the economy. But many investors do not recognize this fact. They do not understand that economic data is old data to the stock market, and they tend to follow the news by looking at the news for the economy or the news for recession. As a result, when the stock market dipped to its lowest in March 2020, they did not enter the stock market. And instead, they started buying more positions when the stock market had already recovered, because that was the time where news start to announce that there are high unemployment rates and the recession is coming. So such a mistake caused them to miss out on the big opportunity and the big rally that came right after. So as an investor, we must always remember that the stock market is forward-looking so that we will not miss out on the big opportunities. If we wait until all the rosy news are out, then we will be late to the party. The last mistake is abandoning or forgetting about your portfolio. So many new investors, they get so hyped up over their first buy that they take it to the social media profiles or they even flaunt it to their friends about their first big step to adulthood. But soon after, they just totally abandon or forget about their portfolio. So they do not review their portfolio regularly, and they do not know how much paper gains they are making or how much paper losses they are making. And I caution you that this can be very dangerous because you may miss out on the potential selling points or you may risk growing your losses even bigger. Companies may not always be doing as well as they used to be, and that's because the fundamentals of the company may change and worsen over time. So when it comes to stocks investing, it is never a set and forget approach. If the investment thesis for a particular stock no longer holds, then it will be better for you to offload it and better deploy your funds to somewhere else to buy a stock that is a better buy. Many investors lost huge amount of money not just because they bought the wrong stock, but because they held on to the wrong stock for a long period of time. On the other hand, no matter how good a stock is, there will always be periods in which the stock prices are in consolidation or retraces significantly because of a temporary negative news. There is nothing wrong as an investor to sometimes trim your profits and take them off the table, especially when the prices are severely overextended or overbought. This is especially profitable if you are someone who knows technical analysis. So as you can see, whether or not the stocks are performing very well or very badly, it will be good to review a portfolio from time to time to ensure good housekeeping and to allow it to go healthily. Now that you know about the 7 common mistakes that new investors tend to make, do watch out and make sure you avoid them. Remember, if you stick to the advice in the video, you should generally do better than many of the new investors out there. And if you can relate to any of the mistakes that we have shared earlier on, do comment in the comment section. Remember to hit the like and subscribe button. And thank you for watching this video. I'll see you in my next video.